Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. Yesterday's morning video touched on some very important and complex topics in regards to our economy and how Wall Street's growth to power has unbalanced the economy. While making that video, for some reason, I kept thinking about the Great Depression and some of the similarities between what led to that economic catastrophe and our current circumstances. I decided to make a shorter than usual morning video quickly going over the most important factors that contributed to the Great Depression. The stock market crash of 1929 was a big shocker to everyone in the world, and even more so to people who worked in the banking industry or traded commodities on Wall Street. All of a sudden, the strategies that once yielded positive results would only lead to losses, creating a havoc and confusion, stalling the ability for America to bounce back quicker and resulting in worsening conditions for everyone. But what led to this? Well, the biggest reason lies in the Roaring Twenties. In the 1920s, the United States enjoyed great prosperity, similar to the 1990s period. It was a decade where money was flowing in the system, where significant changes were made that improved the lifestyles of every American and where there were little worries about potential wars in the world. However, at the end of this decade, there was a sudden economic slowdown, causing a recession in the latter half of 1929. One of the biggest factors that led to this economic slowdown was the Fed. They worried about an excess of speculation, so they began tightening at the beginning of September. This is very similar, albeit for different circumstances, to what is happening now. The thing is, back then, the economy experienced recessions every 2 to 3 years, so it was fairly common, and that led to people underestimating that one in particular. Other major causes for the depression were an overconfidence and oversupply. Businesses were overproducing but selling their goods at a loss, which went unnoticed by most investors. Investors were buying on margin at exceedingly dangerous levels. Borrowing money from stockbrokers was very common, and this overconfidence led to surpluses in industries. These things combined with the Fed beginning to raise interest rates, like they are doing right now in 2022, led to a worsening situation. One thing that goes unnoticed were the bad moves made by the government as well. Congress passed the Tariff Act of 1930, better known as the Smoot-Hawley Bill. Essentially, this was a bill that imposed high tariffs on other countries. As a result, other countries retaliated with their own tariffs on U.S. goods, which led to our imports falling 40%. This was the final nail in the coffin that sealed the stamp on sending us on a downward spiral for much of the 1930s. People tend to think about the Great Depression as a result of a stock market crash where the United States was unable to bounce back from. Though there was indeed a crash that took place in October and early November of 1929, there is actually no supporting evidence that backs this up, making it a wrong assumption. The stock market actually had a very strong recovery after the crash. The biggest villains in the story are the banks, to the surprise of no one. You see, banks had begun extending a lot of bad loans, which meant that banks were speculating too much. When the banks began to fail in 1930, that led to a domino effect where more and more banks began flipping over. Because we did not have deposit insurances back then, people lost all their money. Banks fails when their asset valuation falls below their liabilities and people don't repay their loans. The Fed can lend money and stop a run on the bank, but if banks are insolvent, there is really nothing they can do but just watch everything collapse on itself. The Fed now intervenes in the markets and adds a lot of liquidity to support the stock markets. There were deep fundamental problems in the economy that were overlooked, and when everyone expected a bounce back, since recessions were so common back then, it led to an overconfidence and little change, which further added to the inability of the economy to make a comeback. Banks' poor strategies and plans worsened and screwed over all their customers. The government's poor oversight is also culpable in all of this, and the Tariff Act constrained the economy into a chokehold that resulted in a depression that lasted for nearly a decade. Economists all argue as to what the biggest lessons should be so that we don't go down the same path again. Some of the most notable ones are that the financial sector should never be left to their own devices. Poor regulation always triggers stock market crash and poor economic fundamentals as Wall Street is hyper-focused on short-term gains. The financial sector is vital to the United States, and because of that, the strongest and most compelling argument is that it needs to be closely monitored and regulated. That is not happening at the moment, which is why the economy is beginning to show weakness and is unable to stop sliding down. Another big important lesson is that all-in-one type of investing does not work long-term. Like I said earlier, Banks began lending money like crazy, and investors began putting all their money in single baskets. They believed they would get high return on investments from mortgage-backed securities and other risky assets, and they were all so very wrong. Government also needs to be ready to assist small businesses. The last recession made it clear that by paying attention to big businesses, especially banks, you forget about all the millions of people who are employed by smaller businesses. The government needs to do much better in balancing the stimulus they give out. In this recent pandemic, the government gave away trillions of dollars to huge companies that simply used the money to pump their stock. That money could have saved thousands of small businesses from bankruptcy if it was handed out more fairly. Back in the Depression-era days, the balance was even worse, which is why the economy had such a hard time finding a bottom and just kept falling. It was like every major point was met with the worst decision that could be made at that particular moment. As you can see, there are a lot of commonalities between what happened then and what is happening now. Of course, things are very different and not all similarities should be used as cautionary alarms, but some of the fundamental problems still exists and need to be addressed. The Great Depression marked a turning point in America where significant changes were made, but as we discussed yesterday, Wall Street has been working hard since then to undo all the restrictions and oversights and regulations imposed on them. They have monopolized power to a point that has never been seen before, and that will only lead to another economic tragedy, which is why it is so important to be aware of all these things. This was a shorter video than usual, but I hope you liked it. Let me know what you think in the comments below, and that is all I have for you guys. Thank you for making it to the end of the video if you are still here. Be sure to come on over and join the Discord for an even more engaging experience with fellow investors. We have tons of things there, from conversations about GameStop and AMC to day trading alerts, so give it a try. Links will be down in the video description. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.